Hi, and welcome back to Five Big Things for the Future of ESG. For those of you who are joining us for the first time, this series builds off of the Pocket Guide to Combat ESG Skeptics, a resource that we launched last year to help investors and practitioners cut through the ideological noise and apply ESG with a little bit more rigor, evidence, and clarity. Each episode is going to tackle one big shift that we believe will make ESG stronger and more useful in today's economy. If you're just joining us for the first time, you can catch episode 1 with Delilah Rothenberg from the Pre-Distribution Initiative. Together, we talked about the future of workers and how they need to be at the center of a new and improved ESG movement. But today, we're heading in a slightly different direction, and we're going to talk specifically about why climate risk is business risk. In the Pocket Guide, we talked a little bit about the need for ESG to move beyond box checking and glossy sustainability reports, and climate risk is a perfect example of why. It's not just an E topic, it's actually a system-wide issue with deep financial consequences. And climate risks really do affect inputs in every single business in material ways. There are physical risks, like the disruption from fires, floods, droughts, heat waves, and that affects who can work and where they work. There are pricing and access risks, especially as our climate transitions. How much harder will it be to get the things that we need to deliver goods and services? And then there are liability risks. What is the role of business to keep those assets safe and protected and productive? The question isn't actually whether climate affects performance, it's where, when, and how fast. The challenge that we find ourselves facing is that traditional financial analysis is backwards looking. It often misses these externalities that build up until they break. And then when they break, they're expensive. In the Pocket Guide, we talk about how ESG loses credibility when it's treated as an add-on, separate from actual strategy. Climate risk cannot be parked within the sustainability team or turned into a branding exercise. It actually needs to inform capital allocation, supply chain design, business continuity, planning, and even investor communication. And firms that treat climate as reputational risk will miss real operational exposure, whether that's input pricing, insurance costs, access to finance, you name it. Which brings me to today's guest, who is right in the thick of building real solutions for this widespread climate problem. Sonam Velani is the co-founder and managing partner of Streetlife Ventures, an early-stage venture fund investing at the intersection of cities and climate. Sonam brings decades of experience across finance, government, and technology, working to deploy climate-smart infrastructure. And her work is grounded in a lifelong commitment to equitable urban development. Sonam, thank you so much for being here.
Thank you for having me. Good to see you, Rahana.
It's really nice to see you. And this is such a pleasure because I think this is the topic that everybody wants to talk about and nobody knows how to talk about. So I'm very glad that you're here because it's very important that you're here. Maybe you could start us off at the beginning, which is what are you building and why?
Yeah, so as you mentioned, Streetlife is an early stage venture fund and we invest at the intersection of cities and climate. And the reason for that is that 50% of humanity lives in cities, 70% of emissions come from cities, 80% of GDP is produced in cities, and 90% of climate risk is concentrated in cities. And all of those numbers, whether good or bad, are going up and to the right. So rather than, frankly, all the doom and gloom that is climate change, we really focus on agency and optimism, right? And how can we actually bring solutions to market? We invest in pre-seed and seed stage companies just as they're starting off across 5 main sectors. We look at buildings, energy, mobility and logistics, waste and water, and adaptation as both the biggest drivers of emissions in cities, as well as the biggest drivers of climate risk in cities. And really all of this comes back to first principles thinking, right? And a lot of what you were talking about at the beginning, it's because cities concentrate, people, assets, and infrastructure. Climate volatility concentrates losses. And when both of those things show up together, those losses then show up as either downtime, repair costs, insurance gaps, regulatory exposure, missed revenues, right? So really for us, this focus on adaptation and resilience is because there are buyers that need these solutions and budgets that are being allocated to financially address these risks in real time. And I'll just give an example. I live in New York City. A few years ago here, we had Hurricane Ida. Or take the wildfires in LA last year, right? The conversation wasn't just about aligning with ESG principles, but it was about lost homes or flooded basements, right? Emergency repairs, lawsuits, insurance deductibles. So it's really, where does climate risk become financial risk, and how can we leverage new technologies to solve for those risks?
You and I probably hear that argument as like matter of fact, in a very matter of fact way. I know that not everybody does. I would love to hear a little bit about how your partners and your investors receive that. Do you feel like that feels organic? Do you feel like you really have to sell that to people? What's the sort of like temperature that you're taking right now?
Well, most people live in cities, right? As I mentioned earlier. So the realities of what's on the ground is very personal to folks, right? Whether they're working in a big corporation, a small startup, anywhere in between. Because whether or not you can take your kids to school because your streets are flooded, these are very local issues, right? And these losses, right, and these climate risks are no longer rare. If you look at global climate related losses on an annual basis, we're looking at almost $300 billion every single year. In the US alone, right, the frequency of billion-dollar disaster events has quadrupled since the 1980s. Last year alone, there were $27 billion disasters in the US. So these aren't just one-off events, right? They're part of a new operating environment. And these shocks are also cascading across systems. So a heat wave might stress the grid, but then the grid disrupts, and that has consequences on logistics infrastructure, on manufacturing, on hospitals, on data centers, whether or not you can use ChatGPT, right? And downtime, and that propagates far beyond that original event. And I think that's what we're seeing more and more often. And because of that, our investors, our partners, our LPs, everybody understands that this is something that we actually need to put money behind. And the pie is also shifting, right? If you talk to me even 3 or 4 years ago and you look at the numbers, 93% of all climate finance used to go into mitigation and only 7% into adaptation. And more, right? That shift is happening because there's a financial consequence to the risk.
Yeah, and you've completely hit on, I think, some of the nuance that's missing in the conversation. We experience this with our clients all the time, right? That most of the conversation that people want to have is either in mitigation, either in adaptation, rarely in both. And I can understand the complexity. These are two very different ways of dealing with the same problem, but they are very different ways of dealing with the problem. I am curious if you could speak a little bit to how the work that you're doing at Streetlife is actually addressing one, both, neither. What are you actually seeing in terms of enterprise solutions to these problems?
Yeah, it's a great question. So both mitigation and adaptation are two sides of the same coin, right?
Right,
And what
right.
we're really looking for is where those do those two circles actually overlap, right? So
Yeah.
in particular, what are technologies that can bring co-benefits to these challenges, right? And that's where we're really excited to invest. So our focus is really on operating models, right? It's things like asset degradation, accelerated maintenance, outages, service interruptions, insurance withdrawal, or frankly, repricing. And volatile OPEX that's directly related to these challenges around heat, water, and extreme weather conditions, and how can our portfolio companies solve for those operating challenges. So I'll give you, a couple of examples
Please.
that we've invested in over the years. One of my favorite companies, our very first investment as a fund, is in a company called Rhizome. And Rhizome helps utilities understand their climate risk and optimize their infrastructure investments to address that climate risk. So say you're Con Ed in New York, which is the utility here. Which substation should I fortify against flood risk, given that basically all of Lower Manhattan, faces severe sea level rise, right? And we've had incidents like Hurricane Sandy where we've had like half of Manhattan basically out of power, right? So
Right.
what are interventions that I should be doing as a utility to protect against that flood risk? Take PG&E in California, right? The power lines, which of them should I put underground to protect against wildfire risk? And all of this has business consequences for the utilities and for their end customers, right? So if you look at large commercial and industrial customers, they can lose upwards of $1 million in revenue per hour during significant outages, right? This is a business risk. The utilities themselves have to go to the Public Service Commission, right, which is a state oversight body. And every 3 to 5 years, they have to go and they have to make a rate case and they have to justify their capital expenses based on a reliability formula. And unfortunately, the United States, most people don't know this, but out of all OECD countries, our grid is least affordable and least reliable, right? And how can we actually deal with both of those pieces in an environment where our infrastructure itself is aging, right? So companies like Rhizome will basically help you figure out, okay, where should I put my money and what is the financial ROI of that investment as well as the social ROI of that investment? Should I be making investments in areas like the Far Rockaways in New York, which hasn't seen much investment in upwards of 30, 40 years, right?
Right.
And again, what are the consequences of that? Another company we've invested in is called 3V. It's actually one of our most recent investments. And here again, right, in an age where we have significant disruption from climate risks to our grid, what 3V does is that they actually use computer vision and machine learning to automate inspections and operations and maintenance for utilities and other large asset holders. And they basically aggregate millions and millions of pieces of visual data from drones, from helicopters, satellites, field inspections. And the company has models that they've built where they can actually detect the defects, they can assess the risk, and then they can generate actionable insights. So something like this reduces the cost of inspections by about 70%, right? And then you couple that with a company like Rhizome, which you take all this data, then you run climate risk models against it, and then you figure out what your capital expenditure should be for the next 5 to 10 years, given the increased climate risk, in addition to the increase in energy demand, which is a much longer conversation. And 3V, right, like the pudding, the proof is in the pudding, as you say, right? So the company that started last year, they've got already $2 million booked in revenue with the country's largest utility. They've got a $20 million pipeline, right? Because utilities need all of this data to actually make these decisions.
Right.
So those are two sort of system level investments, right? And sort of infrastructure oriented investments. But how do you think about, individuals, right? What happens when you and I suffer from climate risk, right? And how can we actually address that? And there, another one of our investments is related to extreme heat. So most people don't know this, but extreme heat actually kills more people than all other climate hazards combined. So you take floods, you take wildfires, wind, hailstorms, et cetera, et cetera. More than, combine all of those, extreme heat still tops it out, and by a mile, right? It kills about 500,000 people, 500,000 people all over the world every single year. And it's a huge public health challenge as well.
Right.
And one of our portfolio companies, Estia, they actually developed hydrogel cooling material. So you actually dip this thing into water, it absorbs the water, and then you put it on as an undershirt, as a neckband, as an armband, and it cools your core body temperature up to 30 degrees. Wow. And think about it, if you're out there in a hot summer day, right? And if you're working as a construction worker or at a logistics firm, your productivity goes down about 50% any day it's above 90 degrees Fahrenheit. And again, you don't need me to tell you that the world is getting a lot hotter before it's going to get cooler, right?
Right.
So they're actually working with construction firms like Kajima in Japan, Mueller Construction here in the US. They work in Singapore where it's like hot and humid year round, with the Ports Authority, with the Airports Authority, with the Public Service Commission, right? Because again, there's a business risk in addition to a health risk, right? And a productivity loss that all of these organizations are trying to solve for while keeping their workers productive and healthy at the same time. So I think those are some examples of how do you actually take these new technologies, right? Incorporate them into your day-to-day operations, into your systems level thinking, into your design elements, and address that climate risk where you turn a lot of that, what's called quote unquote sustainability, the value proposition shifts from just sustainability to predictability, right? And avoiding losses and stabilizing your operations.
Yeah. One of my biggest frustrations, I think, in the pushback around climate is that it divorces from reality, I think, how much this is about people, their quality of life, their longevity, their livelihood, their productivity, and then also the way that they fuel business, right? As I sort of said earlier, we think about communities and societies as recipients, but they are an instrumental part of the way that we sort of generate goods, services, means in this country. And so it's been frustrating to watch the pushback against climate because I think what I would assume you and I both believe is that it is a risk. It needs to be priced, it needs to be incorporated, and then eventually mitigated in order to keep communities safe, people safe, but also businesses productive. And I think you and I, especially here in the US, have seen that go in the opposite direction, right? It probably feels to you like it does to me, which is a little shocking that this could even be political because it feels so much like imagine if we had the same backlash against financial statements. Just imagine for a second if someone was like, financial statements are so political, we can't disclose this information. Shareholders all over the world would just be like, what are you talking about? It's having transparency into the business's performance is part of risk. All three of your examples are a reminder of how people and business and community are actually part of this virtuous cycle of fueling, I think, economic productivity. I wonder if you could talk for a second about what you're seeing as climate adaptation as a competitive advantage. Let's keep the political environment aside, but as a competitive business advantage juxtaposed against this conversation we're hearing nationally about it sort of constraining business and constraining revenue. I wonder if you could talk us through a little bit actually how you're seeing the opposite, because I think you've mentioned that you are.
Yeah, absolutely. I mean, we talk to startups all the time, but we also talk to large corporates all the time, right? Because
Right.
ultimately we focus on B2B companies, right? And
Right.
these startups, as they grow, as they scale, they've got to build partnerships, right? And sales and operational sort of elements with these companies. And at Streetlife in particular, we actually partner with cities, with infrastructure groups, and with real estate firms to help early stage companies deploy their products, right? Either in the physicality of the built environment, if they're hardware companies, or through technology systems, if they're software companies. So that engagement basically starts from day one of our investment, if not prior, right? In getting to know the company and what they're building. And I
Right.
will say, inside of all of the companies that I talk with, right, climate exposure shows up almost constantly in their operating models, in their capex prioritization, in risk committee agendas, right? It might not make the front page of the Wall Street
Right.
Journal or the New York Times, right? But people
Right.
do talk about it. And
Right.
CFOs have basically stopped asking these abstract questions, right? And they're talking about operational ones, right? So which assets are most at risk of losing insurance, and how does that hit the
Mm,
bottom line? What does 1 hour, 2 hours of downtime look like during peak demand periods, right? And how does that impact our potential revenues? Things like how much working capital do I need if there's an increase in weather volatility, right?
right.
And particularly businesses that are seasonal really think about that even more because they've got a short period of time in which to do this work, right? Construction firms, logistics firms, as I was talking about earlier, are a really good example of that. And we're already seeing a lot of these shifts, right? So, for example, we talk to tons of data center operators, right?
Hmm.
They are modeling heat-driven cooling costs. They're modeling the amount of water they need. They're modeling all of these different factors to keep
Right.
their data centers running while
Right.
facing fairly public backlash, right? In terms of coming in, using up all of the electricity capacity, et cetera, et cetera. If you're
Right.
looking at logistics firms, they are rerouting networks, right, around some of these areas that might be flood prone. If you look at property owners, right, real estate owners, they're actually looking at underwriting flood prevention against NOI loss.
Right.
Because really what it comes down to is that sort of these investments in resilience, they're not necessarily competing against growth, right? They're facilitating growth and capex, and they're winning on ROI.
That's right. That's right. And I think that's the key proof point. It's part of the reason we wanted to write the guide. It's part of the reason why you're sort of in the market talking about all of this. There are proof points, and they're maybe not as unequivocally sort of clear that that this is because we've invested in climate, but I think that that actually speaks to the interconnectedness of the issues that we're trying to program for. And sustainability, impact investing has always sort of found itself on the difficult end of that, right? These are very complex, interconnected issues. If they were simple to invest in, if they were linear, we would already be doing it. Like, this is part of the problem here. So we may not ever get causation. We may not ever get, like a truly, like, because we did this, X happened. But I would argue that the traditional investing doesn't have that either. And it sometimes feels like a different set of evaluative tactics for something that is so systemic here, and then something that is considered less systemic on the other side. And I wonder, I mean, we're talking mostly about Streetlife and what you're doing at the sort of enterprise development stage, but across your career, you've also done a lot around city and government and community. And I wonder if you could talk a little bit about where you see the connective tissue between what you're trying to do on the capital provision side and what you've seen on the policy and governance side.
Yeah, it's a really good question. I mean, I think just to your earlier point, one thing to note, right, as we're talking about risk and again,
Yeah.
where it shows up, I often think about like how markets function. I used to listen to Bloomberg radio when I was in college 20 years
Yeah.
ago, and this is like
Yeah.
how I learned about markets, right? I would like be
Yeah.
sitting there writing my papers
Right.
uh, and like listening, and I to this day like that habit continues, right? So I'm
Yeah.
constantly listening, right? And I think what markets can be inefficient, right? And there's
Yeah.
some often are inefficient, particularly when you have these types of losses that used to be one-off and are now showing up, in operations. But the
Yes.
cost of capital, right, is diverges significantly based on physical exposure, right? It's not
Yes.
just one sector. So you look at lenders, right, and insurers, they basically are becoming kind of de facto climate regulators, right?
Yeah.
Because if you can't get insurance, you can't get financing to go and buy your asset, whether it's a home, it's a
Correct.
commercial building, whatever the case might be, right?
Correct.
If you have higher deductibles, higher equity requirements, right? So that climate adjusted underwriting kind of is starting to become more standard because it has to stress test against heat, flood, outage scenarios and what the pricing
Yes.
volatility will look like, not just the historical averages. So I think what you
Right.
said just now is like spot on
Right.
in terms of how we actually understand this. But
Totally.
to your question on my own background in my career, right? Yeah, I've spent my entire career across sort of this intersection of cities and climate, right? And
Yeah.
cities, climate, and capital in particular. And what I often see is that governments, especially in the adaptation space, they used to be the ones that were saying, hey, we've got to do X, Y, and Z. We're going to put, a bunch of new money for bigger sewers in our budget.
Right.
We are
Right.
going to put a bunch of new money to enhance coastal resilience mechanisms, right? And I used to work at the mayor's office in New York City, right? I led the development of New York City's climate plan. It's New York being New York, it's $15 billion, 30 different
Right.
initiatives, right? It's very big.
Yeah. Yeah.
But a lot of these discussions stemmed from Hurricane Sandy and then the subsequent disaster events that we've seen here over the course of the past 10, 15 years. And again, what that means from a financial risk perspective, both for a city's balance sheet, but
Yeah.
also for the private sector, right? So there's
Yeah.
only so much government can do. And that's why, cities around the world have created resilience officers, chief climate
Yep.
officers, right? To
Right.
both bring together the policy agenda, the investment agenda, and then also the private sector, right? And creating legislation for the private sector to both do its part, but also understand its risk.
Yes. Yeah. I think what I also find so interesting is that so many cities share the same burden in a way that feels so different from the kinds of climate risks and threats, at least in the continental US, that we used to see before. I lived in the East Village during Hurricane Sandy. I'm in New Orleans now, and we bought our house right before Ida. And two hurricanes were not on my bingo card, let alone, right? Like, that wasn't part of the plan at all. But what used to make sense in the Gulf now somehow seems to be sort of a Northeast coastal issue. And so I think that's also just a reminder of how difficult this particular set of problems are. They're not necessarily picky or choosy about where disaster sort of strikes, It is no longer a global South only thing. It is no longer a Gulf Coast thing. It is an everywhere thing. So I really, really like what you said about cities and maybe even capital now working more closely together to lead, follow, because I actually think that seems more analogous to the way that we are living. We are not living in a sort of society where capital is driving all the solutions, and we're not living in a society where government is driving all the solutions. So we really do need both. I want to maybe ask you about, for our last question, because it's actually the most important question, I want to ask you a little bit about what you would need to see to know that the work that you're doing at Streetlife, the work that you're doing at this intersection is working. What are some of the proof points that would give you a sense of like, okay, we're actually heading in the right direction?
Yeah, I'll give a very concrete example. So our company Rhizome that I was talking about earlier, the one that works with utilities to help them understand their climate risk and optimize infrastructure investments to address that climate risk, they are working with over a dozen utilities, large and small, mostly large actually, but large and small. And they started in the United States. They have since expanded to Canada, to the UK, to New Zealand. They're actually in a program in Australia right now, right? And across all of these different geographies, what they're seeing is that because utilities are actually utilizing this data, right, as a part of their rate case, as a part of their CapEx planning, they've actually been able to reduce downtime. They have used, again, modeling tools, right, to actually figure out what's wrong. And Rhizome works with one of the largest the largest utility in Texas. They work with groups like National Grid, right, which is a huge utility up here in the Northeast and across the pond in the UK. And in every single one of these scenarios, they have seen CapEx for resiliency investments increase substantially, to the tune of 30 to 40%. And if you look at, utilities writ large across the United States, the numbers have gone up significantly. What used to be spending of, $400 million, $500 million, this is now, if you look globally from 2025 to 2030, all of the utilities across the US combined, they are collectively spending over $1.4 trillion on resiliency investments. So I think the numbers prove right themselves, right, as to why organizations are spending to make sure that their systems, right, and that this infrastructure that we've built keeps up with the times.
Totally. Yeah. And it's just an excellent reminder that investments in resilience are just that. I think that terminology has been co-opted, but that's not what you're saying. You're saying actually we're talking about true business ecosystem resilience. It's actually not interesting at all. It should be really boring. We should all treat it like just risk as usual.
Exactly. The unsexy stuff, right?
The unsexy stuff. Yeah, exactly.
But yeah, I mean, we're in the VC game, right? Like we're looking for huge returns. And I often say, for every, the stat used to be when I got started in my career, I remember when I was at Goldman and at the World Bank, we used to use this stat for every $1 invested in pre-disaster mitigation, you save sort of $6 on the back end, right? And post-disaster losses. That number has gone up to upwards of $15 to $20, right? Saved. On the back end because of the value of these investments and the associated potential losses, right? So those are the kinds of numbers that we want to see, right? You want 20x, 30x, 50x return on your investment.
Yeah. And I think Streetlife, among other funds, are sort of trying to prove the case that you can have your cake and eat it too. I'm not at all suggesting that it's simple and that trade-offs are not abound. That's the name of the game in our space. But I do think that we are seeing in real time that investing in climate adaptation, mitigation, resilience doesn't necessarily undercut enterprise, opportunity, productivity, GDP. It actually does the exact opposite. You need to take the right view of it and you need to do it responsibly. But it's part of the reason why I'm so excited that funds like yours are in market, because I think it's going to be very hard to disprove once we start to have some of that data and performance. I think it's going to get harder and harder to be like, no, this is a bad idea. Well, not quite. That's not quite how it's going.
And
Yeah.
and when we got started, right? I mean, again, I've worked in this space for like 20 years, right? People didn't know
Yeah.
what like venture capital was for climate
Right.
adaptation, right?
Right. Right.
And frankly, people didn't even talk about this 3 or 4 years ago, right?
Right. Right.
The sky has turned orange now in San Francisco, in New York, right? In Canada,
Right.
all over.
Right. Right.
Right? So it's like we're now seeing the consequences of climate
Yeah.
risk, right? And the capital is starting to follow to
Totally.
address those consequences.
Totally. And totally, we'll just keep seeing more of it.
Right. So,
Yeah.
yeah.
Sonam, thank you. It's always such a pleasure to chat with you. I just feel like you bring such a accessible sort of frame to what can sometimes be a really difficult conversation. And just a reminder that we all are sort of invested in the outcomes of this work and the integration of this work. So I so appreciate you being here and thank you for joining us.
You got it. Thank you for having me, Rihanna. Good to see you.